As much as I love my asset class, I'm a little bit worried about how far we've moved with actually significant downward revisions to earnings expectations around the world, cyclicals and defensives. And I think there's maybe too much complacency on trade and geopolitics, too much complacency around the Fed, and perhaps too much complacency when it comes to sort of stability of growth in all regions currently.
So that's a perfect jump off. We've debated and discussed on the show almost every week as to whether the move off the lows in December is justified, whether stocks should really be where they are, given the fact that earnings expectations are still low. Is this justified?
Well, you say low, but think about it. The fourth quarter was better than expected, and guidance, in fact, was somewhat better than expected. We had revenue growth of the companies that have reported so far, and that's maybe 75% of them. That's 7% higher over last year, and earnings growth at 13%. And the guidance was a little bit better than expected. So while the market came crashing down because of fears about earnings slowdown, recession, global growth, China, interest rates, you really feel that there's a sense of comfort and what we've seen so far. And this rally, by the way, has been much more measured and calm and steady than the panic selling we had in December. So that feels better.
Measured. It's been quite a bounce from the December, from Christmas Eve.
But there hasn't been any day that's 3.5% or 4% up. It's sort of a grind that's
But it's been largely an unabated rally, though.
Correct.
Right? Nothing has seemingly gotten in its way. Once you've got the Fed back on your side, so to speak, the market's gone straight up, regardless of what earnings expectations are likely to be in this quarter and maybe next.
Yeah, there's been a tremendous pivot on the part of Chairman Powell, and now the conversation will be about what do they do with the balance sheet and when does the QT of the balance sheet end. More likely it will be Q3, but it could be sooner than that. So this is the pain zone right now for those, myself included, who feel as though they're kind of under invested in this equity move higher. We've achieved for the S&P 11% higher. It looks like we're going after that 20%, which takes you to the all-time high. I've been very suspicious that we can get there. However, that being said, there are some conditions within the market that suggest the momentum is clearly there. It's not just about technology. Materials, industrials, and energy are participating. You're seeing energy and the credit markets heal once again, and the VIX is now trading below 15, which we didn't think was possible just 6 weeks ago.
Yeah. So, Doc, FundStrat's Tom Lee takes everything into consideration, says equity markets will likely enter a 2 to 4 month period of consolidation in late first quarter, early second quarter, begin to digest their recent oversold gains through a period of sector rotation. Well, is something about to give? We cannot go straight back up to new highs, can we?
Well, when I'm looking at Joe and Pete already cited volatility in the market, and obviously with us now 14 handles strongly down on the low end of the 14 handle. This is the lowest level since the beginning of October. The lowest level also in the VIX for the bonds, Judge. So when we're talking about the Fed speaking later today about the pivot that they made in January and how dovish that was, and keeping in mind, of course, that the Treasury Secretary as well had those miscomments about meeting with all those heads of the banks and so forth, the thing that he wished he could have pulled back and we all wished he never said. That all contributed to that pump up in volatility for bonds as well as for the stock market. Now, I think we're working our way out of that. So can we see a rotation like Tom Lee's talking about? Of course we can. We could see that rotation. In some cases, you're already seeing some of that. You've seen just this surge of money into energy and resources. We talked about Freeport yesterday. We talked about Encana and some of the California resources. These stocks have made monstrous moves already. I think those moves are probably as far as they go for the short term, unless energy itself, unless oil and gas make a significant move. I think those moves are almost done.
It sounds to me, Kate, correct me if I'm wrong, that you're skeptical on the question of whether we can
make a new high. Yeah. And look, I would say when we look back at the fourth quarter, everyone is trying to retrofit a narrative. I mean, there are like a lot of things that were contributing to the sell-off. A lot of it was technical. There was a lot of liquidity concerns. But, it wasn't just geopolitics or policy or growth. There was just a confluence of things. And now we're all trying to tell a story about what is reversed and therefore should get us to new highs. I'm a little bit skeptical that we'll get there in the near term. And I mentioned the earnings revisions. I'm really focused on this. And in fact that, analysts are aggressively cutting their expectations. I would note that some of the sectors that have been leaders, especially on the resource side, year to date, have particularly poor outlooks for full year 2019 unless we get a meaningful move up in the commodity cycle.
But that's a small percent of the S&P.
It is. Altogether, the three sectors that have negative expectations for 2019 make up 11% of the market cap. So you're absolutely right. It's not a huge portion, but it's about the spread between the winners and the losers. So maybe Tom Lee's call for sector rotation makes some sense. We're going to have to rethink who leads.